Welcome to this explainer. Today, we're doing something really exciting. We are taking UFP Technologies and putting it through the ultimate valuation gauntlet. You know, as an investment analyst, it's rarely enough to just glance at a stock chart and call it a day. Today, we're taking a deep, quantitative dive into the numbers, using the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, alongside your traditional discounted cash flow and multiples models. It's going to be a fun one.
Here is our roadmap for today. We'll start with a quick company snapshot, then filter the data through the lenses of Buffett, Lynch, and Graham, dig into the DCF models, and wrap it all up with our synthesized final verdict.
Section 1. Company Snapshot. Let's establish exactly what we're analyzing today.
So UFP Technologies, trading under the ticker UFPT, they're a specialized custom manufacturer. But the absolutely crucial thing to understand here is that they've executed a massive strategic pivot. They are now primarily serving the MedTech industry. We're talking highly engineered components, think single-use devices, packaging for robotic surgery, and infection prevention tools. In fact, over 90% of their revenue now comes from this highly regulated, incredibly sticky medical sector.
Let's look under the hood at their baseline financials. We're looking at a $1.75 billion market cap company, trading right around $226.52 a share. Their trailing 12-month earnings per share sits at a really healthy $8.81. Valuations-wise, they've got a PE ratio of 25.74 and a forward PE of 23.60. Now that's for sure a premium multiple, but keep in mind they are operating in a premium space.
Moving right along to Section 2, the Warren Buffett lens. Let's see if this meets his strict criteria.
We all know Buffett loves an economic moat, and UFPT actually has a really deep one. With that 90+% MedTech revenue, they've managed to secure exclusive manufacturing rights for a huge chunk of their safe patient handling business all the way through 2030. That is incredible revenue visibility. Management quality looks stellar too, backed up by successful customer co-investments in new facilities and a super smooth upcoming CEO transition to Mitch Rock. Quantitatively, consistent earnings, solid 29.1% gross margins, an ROE approaching 16%, and a very manageable debt-to-equity ratio of 0.32. Honestly, it checks almost every single qualitative box Buffett has.
But here's the catch. Buffett is a value investor at his core. To figure out his buy target, we calculate owner earnings. Assuming roughly $67 million in owner earnings based on current free cash flow and net income proxies, and demanding his standard 20% margin of safety to protect against downsides, Buffett's buy target would likely trigger right around $180 per share. So at the current price of $226, he'd definitely admire the business, but he's going to sit on his hands and wait for a better pitch.
All right, Section 3, the Peter Lynch lens. Time to shift our focus from deep value to the growth narrative.
Looking at their recent investor presentations, which highlight a 12 to 18% targeted annual growth, Lynch wouldn't call this a slow-moving stalwart. No way. He'd categorize UFPT as a fast grower. They are rapidly expanding their capacity, specifically throwing up new facilities down in the Dominican Republic to support major MedTech programs.
The holy grail metric for Lynch is the PEG ratio. That's price to earnings divided by growth. And at 1.14, UFPT is sitting beautifully close to his ideal target of 1.0. When you pair that near-perfect PEG ratio with a rock-solid current ratio of 2.91, which proves they have immense short-term liquidity, this stock looks highly attractive through the Lynch framework. For a fast grower with a pristine balance sheet, Lynch would likely rate this a straight-up buy.
Next up, Section 4. The Benjamin Graham lens.
Let's put on our most pessimistic glasses. Graham is famously ruthless. He wants hard, cold assets and earnings today. Let's run his defensive investor checklist. Adequate size over $500 million? Pass. Strong financial condition? Pass. Earning stability? Pass, with that solid 8.81 EPS. But then we hit a brick wall. Dividend record? Fail. They don't pay one. Moderate PE under 15? Fail. It's near 26. Moderate price to book under 1.5? Fail. It's way up at 4.09.
Let's actually run the math on his iconic intrinsic value formula, the square root of 22.5 times EPS times book value per share. Our data source didn't explicitly hand us the book value per share, so we had to calculate it by dividing the current price by the price to book ratio, giving us an assumed $55.38.
Punching in those numbers, Gram's intrinsic value sits exactly at $104.77, meaning at the current price of $226, there's absolutely zero margin of safety. A true Gram defensive investor wouldn't touch this stock right now. It's just way too expensive based on current assets alone.
Section 5, DCF and Multiples Valuation. Let's bring in the quantitative heavy hitters.
Our sources highlighted a very bullish base case fair value forecast of $329.50. To get there using a discounted cash flow model, you have to assume a 3% perpetual terminal growth rate and an 8% weighted average cost of capital, or WACC. But check out the sensitivity table here. If the risk profile increases just a bit and we demand a 10% WACC and growth slows to 2%, that fair value plummets to $240. This is a perfect illustration of just how sensitive growth stocks are to your assumptions about the future.
To ground those DCF numbers, we also looked at comparable multiples. UFPT trades at an EV to EBITDA ratio of 17.38x, a forward PE of 23.60x, and EV/sales of 3.21x. These definitely indicate a premium valuation relative to broader manufacturing. But when you align them with high-growth MedTech peers, it suggests a fair value range much closer to $235 based on industry medians. So that pulls those lofty DCF numbers back closer to current reality.
Finally, Section 6, Synthesis and Final Verdict. We've run the gauntlet, so let's put it all together. It is fascinating to see the tension here in our final scorecard. The Peter Lynch framework and the optimistic DCF models are screaming buy on the strength of that MedTech growth narrative. Meanwhile, Gram and Buffett are urging caution. They see the quality for sure, but suggest the current price of $226 leaves little to no margin of safety, and the multiples? They suggest it's currently fairly valued.
Blending all of this, our final verdict is a solid hold. Why? Well, their T-strength is undeniable. Expanding that Dominican Republic capacity directly alongside major robotic surgery clients is huge, but the key risk is just as massive: customer concentration. They are heavily reliant on giants like Intuitive Surgical. You are paying a premium multiple for an excellent company with a deep moat, but right now it's priced for perfection. Any slowdown from that concentrated client base could compress that multiple really fast.
The underlying business is stellar, absolutely. But as analysts, we know price is what you pay and value is what you get. So I leave you with this thought. Knowing the math behind the magic and seeing exactly how the legends would model this out, at what price does this high-flying growth story finally become a screaming value buy for you?